Welcome back to the Gray Report. Joining me once again is Jay Reeder, Chief Investment Officer here at Gray Capital. Jay, how we doing?
Doing well. Happy to be here.
Glad to have you back on. It's always exciting because we're always looking at deals. We're also banging our head against the wall more and more as we're trying to make sense of things. And what we're going to talk about closer to the end of the episode is this challenge of where we're very bullish on the long-term fundamentals, and we can talk about that too. But the near term, we're so uncertain, especially 2026.
Very much so.
And sometimes, we have to just manage the emotions and the psychology of trying to make decisions and, trying to parse through data, but also using intuition, but not letting our emotions take hold of ourselves. So I'm excited to talk to you about that. But first, I want to get into this report from RealPage titled U.S. Apartment Prices Fall for the Third Straight Month Amid Easing Occupancy. And then a quote, so price declines across the U.S. were inspired by easing occupancy rates. U.S. apartment occupancy fell for a third consecutive month, dipping to 94.9% in October, according to data from RealPage Market Analytics. Occupancy was 20 basis points below September, showing and down 60 points in the last 3 months. However, year over year, occupancy actually was up 10 basis points, which was a little surprising to me. So some higher vacancy, lower occupancy, and this is also being, fueled or leading to some rent declines. So, nationally, annual rent change were down almost by a full percentage point, down negative 0.7. We're going in the winter, right? So we're probably going to see further declines, most likely in November. December typically isn't the hottest month, and neither is January. Monthly rent change, 0.8% for an average effective rent for the nation of $1,858. Now, demand has been strong, but I guess how is this translating from an asset management perspective when you look at our portfolio? Does this resonate with what's going on, what we're seeing?
Oh, it's definitely what we're seeing. And I think you and I kind of started seeing it. I mean, I remember sitting in our asset management meetings in March and we're like, holy cow, we're going to recover from kind of the slump of last year.
Yeah.
And then all of a sudden, April, it's like, okay, maybe people just kind of pushed up and were more aggressive in March rather than April. But then all of a sudden, May came, June came, and we saw this steady decline where, I mean, one of our largest properties, we had one lease for the entire month of July.
Yeah.
And it was okay, fortunately we did some really good pre-leasing and we were a bit more proactive on some of these things. But I mean, you definitely see the results in kind of the meetings we're having in asset management of okay, protecting ourselves going into winter and understanding kind of what our exposure is, because sitting at 95 and people paying bills is a lot better than trying to get traffic that doesn't exist and sitting at 89%.
Yeah, I feel that. So I've heard the argument being put out there that, kind of like you said, demand was just pulled forward a little bit, and the leasing season has just shifted a little bit earlier. So we just had more leases in March, but it was basically the same. Just it was a little bit front loaded. Does that carry much water?
I mean, I don't think so. Did we see that on the margins maybe in April and May? But to see just the dearth of activity across our portfolio in June, July, and August, there wasn't enough traction in March and April to say that those people just moved up.
Yeah.
Now, the one thing we can say is a lot of people were staying put. Our renewal rates across our portfolio were incredible. I think at one of our largest properties, we had a 61% retention rate this year.
I think the highest, another property, it was basically at 70 to 69%.
Yeah.
But a lot of our assets are right at 60% versus the average of close to 50%.
Yeah, so I think that helped a lot. But if all of these people are staying put at other apartment communities, then that's something that I think we just had to deal with from a traction standpoint, because I think in the past people were kind of shopping, hey, I want to stay here, but if I can get a good deal over here, maybe it's worth me moving. I do think that the market has found somewhat of an equilibrium where it's really hard. I mean, I know we've kind of put together some marketing information at some of our properties of yeah, you say you want to move, you don't like the renewals that we're giving you, but here's how much it's going to cost to move. Here's how much a deposit you're going to have to put down. Here's how much all this, you average that out over the increase that we gave you, and you're coming out money behind. And I think people are starting to realize that. And
Yeah.
I think that people are like, you know what, I'm going to stay. Yeah, maybe my renewal was 7-8%, but I'm still below the market and I would be up 12%. Maybe that place has a concession, but I'll get for 2 free months, but then I'm going to have to pay that every month thereafter. And I do think we're seeing some of that in the market.
So, renewals are plugging some of the hole from, new lease traffic. Is it enough are we basically just treading water with those renewals? Or making any significant growth?
From an income standpoint, I would say I'm probably 2/3 of our portfolio. I would say that the renewals we're pushing them enough to say that we're moving forward. There is a portion of the portfolio that we're getting the renewals, but we're kind of treading water. And so I do think that it's situation by situation, and it just kind of depends on where the property is in the market and kind of what the resident sentiment is. But I would say there's one property right off the cuff. I know it's like you and I have talked about it. Our income is virtually identical. September of 2024 versus September of 2025. One of our best properties, but there's just no movement in that market.
And expenses aren't flat.
Then I have another property, and that one, I remember last year doing the budgets, and I remember our partner on the deal was like, you're being too aggressive. Like, they're not going to hit it. And we've basically hit it with renewals this year. We're maybe off fractions of a percent on our income. But I mean, we have just been blowing it out of the water. I think we're at like average 8% on renewals, and like new leases. Some months we are 10%. So, I mean, that one, I can see that we are far beyond treading water at that one. But I think some of them that had kind of already hit the peak definitely were treading water.
Yeah, that's I think that's what pretty accurate description. So kind of going back to this, pulling demand forward, even though it didn't make up for like the volume of new leases in March, for the lack of volume throughout the rest of leasing season. The reality is, though, I mean, there were a lot of leases signed in March, which means that, a 12-month lease, they're going to be renewing in March. Going forward, I guess, do we see that leasing season, maybe not necessarily start earlier, but start stronger in March and a little bit more even throughout the rest of the months?
I think it's going to be us being conscientious of our kind of renewal wall. I mean, we had one property where I think 60% of the leases expired in like March, April, and like the first half of May. Fortunately, that one renewed a lot, but that property specifically, I looked the other day, and we've very much evened out kind of that wall of expirations.
Yeah.
And so that property I feel pretty good about kind of where they are between now and kind of when those renewals come up next year. Even if it pulls forward a little bit. Some of the other ones, I mean, we have some properties in some student markets that it's just hard. Like, even if it's not a student property, and we don't live in the student world, but we are affected by the student calendar very much, there are just some that March is just hard. I mean, March in a college town, that's spring break. Like, there aren't people there. And so it may never pull forward in those markets. And so then we feel the stress come end of April, beginning of May, into June, before kind of it's a ghost town in July, and then just kind of hope that everything picks up in August.
Yeah. So the dynamic pricing is also impacting kind of these lease expiration schedules. It's something that we talk about more and more because we use dynamic pricing in a portion of our portfolio, and more frequently for projects that we're underwriting to buy, they're using dynamic pricing. Can you just kind of briefly explain what dynamic pricing is and how that may be changing the market from operations but also acquisitions?
Yeah, I mean, we had a whole conversation on it here probably the last 2 days in our office, and obviously there's been a lot of talk about the dynamic pricing in the news with the lawsuits. I think the products themselves have kind of adjusted, and we could sit here and talk with Katrina. She's a great person to bring in, but they really kind of focus on internal metrics now heavily, just because of some of those safeguards that they put up. And one of the deals that we're looking at right now,
first, just you could do a kind of brief overview, like what dynamic pricing is, if someone's not familiar with.
For dynamic pricing, it's just, hey, basically our price is reset every day, and it's, hey, you come in today, you get quoted. this is the price for today, but if you don't lease today and you come back tomorrow, you may be paying a different price.
But and it's not only on the different day, but the price also changes based upon your move in, when you want to move in,
Yeah.
and when you want your lease to expire. And so that there's less and less. And there's still, the majority of leases are still 12-month leases, because people are like, I want a year lease. But there's a whole matrix of, you want a 10-month lease, you want a 14-month lease. It may be cheaper to do a shorter or long-term lease based upon what our lease expiration schedule is.
And that's probably the biggest thing is like we have kind of caps for each month of how many leases we're willing to have in each month. And Katrina kind of says a good rule of thumb is no more than 13% of your lease is expiring in one given month.
Yeah.
And so basically what happens is kind of once we hit that cap, even if it makes sense, we just don't want that exposure. So it makes it a new person coming in off the street much more expensive for them, because we have to compensate for the risk on the back end of the increased vacancy if we have too many people leave in that month a year from now.
So like someone, I want a 14-month lease, but that's going to make it expire in January. And like, we don't want too many leases to expire in January because no one's, or December, no one's looking for an apartment, right before Christmas.
Yeah.
And so it's like, okay, your lease can expire in December, but we're going to charge you an additional $100 per month because we're going to amortize that vacancy, because we're going to have to hold on to it for another month or two. And so I guess, when you're looking at deals, underwriting to buy, how do you take that into it? And we're actively, doing this, but how do you think about taking that into account? Because also it's like when you ask, what are your 2 bedrooms going for? There may be a $200 or $300 difference between what people are being charged on the rent roll, depending on when they sign the lease and when their lease expires.
Well, and that's the hard part too. And we just have to really kind of dig into the rent roll, because I mean, the in vogue thing to do is like, what's the average of the last 3 leases signed?
Yeah.
Well, okay, what's the average of the last 3 leases signed on a normalized amount? Because like the last 3 leases signed, maybe someone, it's not even a short-term lease. Maybe it's like you said, a 14-month lease, but like that's what they have to do for whatever reason. But their AIRM or their revenue management or whatever they're using is set up to like, hey, we're not going to. Well, that's artificially inflated that rent. And I know Addison has gone through on a couple of deals that we've looked at that were kind of lease up type deals, that all of a sudden, like, they signed some really, really strong leases and got some really good rents in like October, November. And it's like, why would you do that? But then you get to like March of the next year and the rents are $100 less. And it's like, what's the real rent? Is it the $1,600 that you signed last November, or is it like the $1,400 you just signed?
Yeah.
And it's like, why could you get that in a harder month but not a prime leasing month? And that's the real struggle that we kind of come across, is we just see these anomalies of like, why were you able to sign this above market lease here, but you couldn't keep that momentum here?
Yeah. And often is that when you look at it, it's a 9-month lease.
Yeah.
And so it's not that you can achieve that on a 12-month lease if someone had a very specific need to have a lease expire.
Yeah, they needed it. But then, like, as an owner, the owner's like, well, I got this lease that shows there are people out there that are willing to pay for it. And so it kind of creates this friction of expectations of what the market is from a buyer and a seller standpoint.
Or a broker saying, look what they achieved. You
Exactly.
can achieve that across your entire rent roll, when that's just not the reality. But if someone sees that and believes it, that's what they're going to bid, and that's what you're competing against.
And then, like, the conversations we've had today and yesterday with those revenue management, what are you solving for? Mm-hmm. Are you solving for getting the absolute most rent you possibly can, or are you solving for being as occupied as you can? And I have one theory, but the owner that's selling it has a different one, but I don't know how they've set up their AIRM. I'm making assumptions that we're going to have similar setups, and we could have vastly different results on that revenue software if we just change those parameters. And that's something that we're digging into right now on a deal that we like, that we know uses revenue management. It's like, okay, we think that there's some room here for rents, but how did you set up your AIRM? Because in my head, and the conversation I had with you is like, they're on revenue management, they should be maximizing of rent they get. So how can I say that they can get $150, $200 if they're on revenue management should be getting it? But if their parameters are set to a way where it's like, no, no, they're really protecting for occupancy, then revenue management isn't going to push their rents. And
Yeah.
so not knowing that is hard for us to underwrite what's actually possible, even
Yeah.
though there's comps in the area that say there should be meat on the bone.
Yeah. What do you think about, just going back to this RealPage report, a theme of the last really year and a half, 2 years is, while we've been delivering a lot of supply, 474,000 through the third quarter of 25, demand has been really strong. I mean, in terms of absorption, there's been 637,000 units of annual demand through the third quarter. I mean, that's a little less than $200,000 200,000 unit difference. Pretty substantial. Obviously, there's demand out there. People need housing. There's a housing, crisis, but that doesn't necessarily mean people can pay whatever. There's certainly some resistance for pushing rents in the current environment. What kind of square that for us when we see that kind of demand,
I think
that supply and negative rent growth?
I think the easiest thing I can equate it to, and I think we've all talked about I'm going to take a couple steps back, but we've all talked about the progression of the industry. It always starts in hospitality, moves to student, and then it filters to kind of market rate multifamily. And if you look at it, obviously all of these new deliveries were the bright, shiny new thing. So the idea is that people want to live in them.
Yeah.
Can people afford them? Maybe, maybe not. But right now, I mean, you and I drive by the north side of Indianapolis. There is a lot of supply north side of Indianapolis, Hamilton County, that are giving concessions that people are able to move into those nice new apartments.
Yeah.
Now, can they stay there long term? Maybe, maybe not. But if it's like, hey, they're giving me 2 months free rent, how can I say no to that?
Yeah.
That's a hard thing to overcome, like a 10, 15-year-old property, when these new deliveries, they just need to get them leased up. And so that's where I kind of see this demand is people are moving into those apartments. People are getting there, but they're not going to ever fetch the rents that they were underwritten to.
Yeah.
And I think that's what we're seeing is the reality is the market was what the market was. COVID kind of inflated some stuff coming back down to earth. And it's like,
well, do you think that, I mean, you said, they'll never be able to achieve the rents that they performed. Maybe one day.
Maybe one day, but not in 2
But
years.
certainly not in their stabilization window. And like what you mentioned earlier, what are you solving for? Are you solving for a certain rent, or are you solving for occupancy? In these owners were, their pro forma in the plan, they assumed that they could get it leased up and the occupancy wouldn't necessarily be an issue. Not that it's easy, but that they think they can do
There's a
that.
plan.
It's more of like, hey, okay, we got to get to these rent levels so we can hit our pro forma. But as the lease up hasn't been going as smoothly as they wanted to, and their carrying costs or interest payments are ballooning, it quickly shifts to how quickly can we be stabilized so we can bring to market to get off this construction loan. And we've thrown in the towel on getting the 20 IRR. We'd like to have a positive IRR at this point.
We just want to break even.
We want to break even. We want to be able to redeploy this capital, and we'll then put it on the buyer as upside, as a value add of, you should be able to move rents because our rents are under market. This brand new, beautiful asset, beautiful units that is leasing up, but we're a couple $100 under maybe some of the existing newer product that's out there, or maybe even at the same price point. Isn't this a great, value basis play? But the cap rate is then so low because the cash flow isn't there. And so you're buying an asset maybe at a good value relative to the cost of replacement, or basis relative to what's been sold in the market. But when you look at your returns, the returns aren't necessarily
They're not there.
They're not there. They're not attractive. So it's really challenging. And for developers, they're solving for a different problem than they were just several years ago.